Hey folks, this is your accountant Mansoor Sohail. I operate out of Toronto and my specialties are tax for Canada and USA. My presentation today is for educational purposes only. It does not constitute any legal advice or opinion, so please do not use any of its contents without seeking a professional advice. So what am I going to talk about today? Tax jurisdictions and jurisdictional issues. First of all, what are the bases for the jurisdiction, for asserting jurisdiction? Who to tax and what income to tax. Personal relationship between a taxpayer and the country. This concept also applies to corporations and other type of entities. A corporation can be considered a citizen of the country in which it is organized and the resident of a country where it has its principal place of business. Economic relationship between the person and the country. A person will have economic relationship with the country from where he derives his income, from property or business activities. US citizens, resident aliens, and domestic corporations are taxed on the basis of personal relationship. Non-residents and foreign corporations are taxed on the basis of source of income. Territorial versus credit system. If a taxpayer is a resident of one country and derives income from another country, it may lead to a problem of double taxation. Host country will assert jurisdiction on the basis of its economic relationship, and home country may also impose jurisdiction on the basis of its relationship with the taxpayer. In such a situation, home country will usually solve double taxation problem either by territorial system or a credit system. Under territorial system, foreign income is excluded and taxpayer is only taxed on income earned in the host country. Under the credit system, home country allows a credit for any taxes paid in the foreign country. This way, foreign country is taxed only one time at the higher of the host country's rate or the home country's rate. Host country's rate or the home country's rate. So let's take a look at the example. In our first example, we assume that host country's rate is lower than the foreign country's tax rate. We are assuming that corporation XYZ has foreign source taxable income of 100. Home country's tax rate is 40%. Host country's tax rate is 20%. Assumption 1. There is no mechanism for tax reduction. In this case, home country's tax is 40. Host country's tax is 20. Total tax payable is 60. Territorial system. Under territorial system, we see that home country has 0 tax to be payable. Foreign country's tax is 20, so total tax paid is 20. Credit system. Home country's tax rate is 40. Foreign country's tax credit is 20 because of the 20% tax paid in foreign country. Total tax payable would be 40 minus 20 is equal to 20. Let's take another example. Host country's tax rate is higher than the home country's tax rate. Taxable income is 100. Home country's tax rate is 20. Host country's tax rate is 40%. Assumption 1. Territorial system exists. So home country tax is 0. Foreign country's tax is 40. And total tax paid in this case is 40. Assumption 2. Credit system exists. Home country's tax is 20. Tax paid in foreign country is 40. Home country's tax credit is 20. Tax to be paid in home country is 0. Tax treaties. Tax treaties provide bilateral solutions to the international double taxation. Treaties reduce double taxation through reciprocal tax exemptions and lower tax rates for income derived by residents of one treaty country from sources within the other treaty country. Tax treaties shift the claim of primary tax jurisdiction from the host country to the home country. Folks, all this information comes from the book reference, The U.S. Taxation of International Transactions, 9th edition. It's actually practical guide to U.S. taxations of international transactions, 9th edition, written by Robert J. Massey Jr. and Michael S. Shadewald. Publishers are Walter Clover CCH Incorporated. Thank you for listening.